Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And let's get straight into the Q&A session today. The first question is from Megan. Megan, thanks very much for the podcast. Thank you for listening, Megan. Anyway, Megan writes, do you know why Queensland real estate agents are still able to charge 2.5% on their property sales as opposed to 1.5% in Melbourne or Sydney? Shouldn't they adjust their commissions now with the higher price points, now higher than Melbourne? Well, I mean, it's a good observation there, Megan. I guess with more competition in a particular market, and I guess, as transactions increase when, particularly after property prices increase, maybe that'll put some pressure on those commissions. But actually, if you look at property managers as well, they tend to be paid more in other capital cities than Melbourne and Sydney. So I'm thinking Perth, for example. Perth commission rates for property managers are a lot higher than the rest of the country. I guess it's just all down to competition, really. And the other thing too, the other observation I'd like to share is that, as investors, we should try and minimize costs wherever possible. But actually, I should reword that sentence to say maximize value, particularly with property managers. The cheapest isn't always the best. In fact, the cheapest is most likely not going to be the best. And the same with selling agents as well. I would rather pay a fantastic agent 2.5% than a very average agent 1.5%. Now, if I'm selling in a buoyant market, the property will probably sell itself. You probably have to be a terrible agent to mess that up. But particularly if I'm selling in a more challenging market, that's really when the great agents really separate themselves from the average, and paying that little extra makes a bit of sense. I guess if you own property across Australia, like I do, like many of my clients do, it all averages out, hopefully at the end of the day. But great observation, Megan, and thanks for writing in. Okay, next question is from Justin. Thank you so much for your great work helping us navigate our futures. You're welcome, Justin. Justin writes, we're planning for our retirement. I'm 55 in February. Well, Justin's already turned 55, given I'm recording this in late February. And my wife just turned 52. I'm inquiring about the 3-year bring forward large superannuation contributions. As I understand it, these rules allow eligible individuals to make non-concessional contributions of up to 3 times the annual non-concessional contribution cap in a single financial year. The annual non-concessional contribution cap is $110,000. Actually, Justin, it is $120,000 for the 25 financial year. Anyway, it goes on. The bring forward rules allow you to contribute up to 330 in one go. Well, that's 360, being 3 times $120,000. For individuals aged 67 to 74, you need to make the work test of working 40 hours in 30 consecutive days if I wish to contribute. Do I have to have a job, or can we use income from properties and trust to qualify if I wish to retire before age 67? Actually, they got rid of the work test for non-concessional contributions. So you can make non-concessional contributions up until you're 74, before you turn 75. You don't need to meet that work test anymore. So feel free to make those contributions. The contribution cap for the 25-year in terms of bring forward depends on your super balance. So if your super balance is less than 1.66 million, you can use the full 3 years worth of contributions, so 360. If your balance is between 1.66 and 1.78, you can only bring forward 2 years, 240. And if your balance is between 1.78 and 1.9, you can only use 1 year's worth of contributions. And if your total super balance is above, this is just your own personal super, not your spouse's, is above 1.9, you can't make any non-concessional contributions. Now, be warned that these limits will change on 1 July. So the transfer balance cap increases to 2 million. So it'll be, if you have more than 2 million, you can't make any non-concessional contributions. So just be careful in terms of planning. I don't know what your super balance is, Justin, but just be careful with planning around that one. Actually, I should have read the rest of the question before I went on to answer it. Actually, Justin writes he's got 6 investment properties, 5 residential, 2 of them in a trust, and plus 1 industrial building, commercial building in joint names. And actually, Justin and his spouse has 180 plus $30,000 in super, so relatively low super balances. It's really funny. I just recorded another podcast as a guest on a podcast show. Yesterday, I was talking about, trying to get more money into super, and particularly that property investors tend to have a lot of wealth or hold a lot of wealth outside the super system. As I said, you can have the transfer balance cap is $2 million at 1 July this year, which means if I have a spouse, I can have up to $4 million of my wealth inside super, and it's going to be completely tax-free. That is no capital gains, no income tax on investment earnings. And so if you're a property investor and you're building wealth purely outside of super, look, if you're many years away from retirement, not such a big deal. You've got time to make those changes. But if you're getting closer to retirement and your focus is primarily on assets outside of super, it's not particularly tax effective, which I think what Justin is realizing. He's got 5 investment properties, hopefully built a lot of wealth outside super, but he's not really making the most of that tax-free cap. Anyway, so he's asking about moving more money inside super. Actually, you can play around with the non-concessional cap a little bit. So let's say I sold a property before June and settled that property, so I received the proceeds. I could make a 1 year's worth of non-concessional contributions, say in June, so 120,000 goes into super. And then in July, I can decide to bring forward 3 years and contribute 360,000 in July. So in that 2-month period, I've contributed 480. I can do the same for my spouse. So in a relatively short period of time, if you happen to really time the sale relatively well, and you can sort of shoulder 2 financial years, you could almost get $1 million into super. And so, Justin, that's what you're asking about. That's probably a good strategy from that perspective, is to start moving as much of that wealth into super as possible. And there's one final element to Justin's question. Justin writes, one more question. Our trust has 2 properties worth about $1 million with about $420,000 of debt and shares worth about $300,000. Are we better off selling our industrial building? It's worth about $1.2 million with about $545,000 of debt into the trust and paying off our home loan as we're heading to 60 fast, or just keep it in both our names? We do have 6 children. Wow. 6 children that we're planning on leaving the trust to. I don't know if I can answer that question in isolation, Justin. I can say that if you move the industrial property into the trust, that's going to trigger both stamp duty and capital gains tax. So I think, that tends to be pretty prohibitive, and it really knocks out, in most circumstances, the viability of changing the ownership of a existing property. So my gut feeling is the answer is no. If you do have non-tax deductible debt, and you're heading towards retirement, you definitely want to have a strategy on how you're going to repay that. But I think you've kind of alluded to the fact that you're going to probably sell down some assets. So, that could be the answer to getting rid of the home loan. Now, whether that's selling the industrial property or selling another property. I mean, when thinking about which properties to sell, the things that I think about are need to form a view on future investment returns. So do you have any dud assets in that portfolio? The other thing you've also got to think about is the cycles, the property cycles in terms of where those properties are located. So, for example, if I had an apartment in Brisbane and an apartment in Melbourne, I'd probably be inclined to sell the apartment in Brisbane, albeit, Brisbane, from an apartment perspective, has gone through a very long flat cycle, mostly because of supply issues, oversupply issues, I should say. But the apartment market really kicked off about 2 or 3 years ago in Brisbane, so it's seen some growth where, I think investment grade apartments in Melbourne, as I've spoken about a lot in this podcast, I think are substantially intrinsically undervalued. So they're the sorts of things you want to sort of think about in terms of where properties are in growth cycles and which ones to sell. Bit hard for me to tell you whether you should sell the industrial property into the family trust, but I suspect the answer is no for the reasons that I've cited. But thanks so much for your question, Justin. Okay, the next question's kind of an interesting one from Shelley. It's quite a long question with a lot of information, and that's not a criticism, but what I'm going to do is just sort of summarize it. So Shelley makes the observation that she finds a lot of my advice is around planning for retirement, but I'm looking for guidance now that I am retired. So Shelley's 60, single, female, no dependents, retired 2.5 years ago. Essentially, her assets are a home worth about $2 million. She lived in there for about 23 years, bought it for $325,000. Should have bought 10 of them 23 years ago, Shelley, of course. $1.9 million of cash, just in cash with Macquarie Bank, earning 5% because Shelley sold a business. $960,000 in industry super fund invested in Australian international shares, so all growth, if you like. And Shelley has a $900,000 loan against her home that's fully offset. It was a previous facility that she's now fully offset. So we can kind of ignore that if you like. Shelley highlights that she remembers a podcast where I talked about having a perpetual portfolio that you need around $2.8 million, earning 7% per annum, and that'll allow you to spend $120,000 a year in perpetuity. So that's a perpetual portfolio, although she highlights that she's only earning 5% on her cash, which is 65% of her investment funds. She highlights that she's not really worried about leaving any money to her estate. She's got a nephew that's 40, happy to help him, but really she wants to live life, and good on you. And so you should live life. So Shelley's asking, well, what do I then do with this money to achieve this perpetual portfolio? If I go and invest in the share market, maybe I'm going to get 2 to 3% in dividends, but that's not going to be enough to obviously fund living expenses. And so Shelley's set out a couple of different ideas. What about going and buying investment property, having some gearing against that investment property? What about upgrading a home to kind of future-proof it in terms of, get a better property, less maintenance, a better area? Or do I invest it all in shares and ETFs and so forth? Shelley said she's met with 2 financial advisors. One, the fees were exorbitant, $36,000 a year. Now, that is exorbitant. I'm not saying that, some clients need to pay $36,000 a year. We've got some clients that pay a lot of money, but they've got a lot of wealth and a lot of complexity to deal with. That's pretty crazy. The other one, I paid $1,500 just to do a scenario if I bought a home before I went and bid at auction. He had the property annual growth at 1%. So in real terms, less than inflation. And investment at 2% said I would run out of money at age 70. I mean, okay. Well, yeah, okay. Doesn't make a lot of sense to me. That's the whole point of paying someone to do some financial projections, is that they're going to consider and use reasonable yet conservative assumptions. And look, finally, Shelley talks about she's got some retained earnings in a company. I imagine it's the company that she used to operate her business in. And she could put $1 million in that company, and that would help her save a bit of tax. So what would I do if I was in Shelley's name? And I guess this is a question, acknowledging that Shelley's retired. And if we can then just earn the 7% per annum, she's going to have a perpetual portfolio. And so therefore the question is, how do you earn the 7% on average over a long period of time and take the lowest risk possible? That's the answer. And in Shelley's situation has a bit of complexity because she's got this company with retained earnings and some other considerations that go along with it. So you want to make sure that the strategy is really tax effective, but also relatively low risk, but still taking enough risk so that you're able to earn the 7% and not need to worry about money ever again. I'm not suggesting Shelley worries about money, but you want to be in that position. So let's address some of the things. Would I go and buy an investment property? Absolutely not. In Shelley's situation, I would not go and buy an investment property. It's just going to lose money. Even if you had some gearing, you'd have to have such a conservative gearing level, it starts to become less meaningful. So maybe a loan to value ratio of like 30%, 33%, something like that. It's not going to really create that much leverage. Doesn't throw off enough income. A completely illiquid asset that doesn't give you a lot of flexibility. So no to the property. Should I upgrade my home? Well, maybe, but I would ask you really what's most important to you, having this perpetual portfolio where you can live a very enjoyable life with some travel and not need to worry about money, or upgrade the home, because you've nearly got about $3 million, which is pretty close to that 2.8. If we go and take $1 million, for instance, and put it in a family home, we've then got $2 million. We're starting to play with, the longevity of that portfolio, which you've suggested that it doesn't matter if you die with zero. And $2 million, you probably could live, well into your 90s and still spending $120,000 a year. I'm just guessing. I haven't done those numbers. But I would just sort of explore, to answer that question, I would explore, Shelley, whether we're going to make any substantial compromises in terms of your standard of living by upgrading that home and putting some more money into a property. What else would I do with it? Well, I would try and get as much into super as possible. You might need to do that over time. Of course, I answered the question around non-concessional contributions in regards to Justin's question. I would certainly put, $1 million, as you've highlighted, into the company to get rid of any Division 7A loans, which are on paper quite costly and actually in reality quite costly from a tax perspective if you don't. And a company is a nice little environment for you to build a pool of assets in anyway, because the tax rate is capped. You're always going to get a credit for the tax that you pay inside that company. You can drip feed out dividends. So I would be concentrating on that $2 million of cash, or 1.9. I put $1 million into the company, and I'll try and get as much money as possible into super, and you should be able to probably get most of that over the next 10 years into super, and you'll be paying yourself a dividend from the company, and then you'll be receiving a pension from super, and that alone should do it. In terms of how do you structure that perpetual portfolio, well, it's really around asset allocation rather than returns. You want your overall return, on average over long periods of time to be around 7% or more. And you don't really need to take a lot of risk in order to achieve that. But the way that I would manage them is I'm not really worried about what the net dividend yield off the portfolio is. It really comes back to asset allocation. So if I know I'm paying this client $100,000 a year, $120,000 a year, I'm going to have at least $300,000 of that portfolio quarantined off in, sort of safer style assets, whether they're kind of hybrid securities, bonds, these sorts of things, knowing that I'm obviously going to receive dividend income over the next 3 years, but at least then I don't have to make any changes to equities over the next 3 years. I've got that liquid pool of assets. And then it allows me then to go away and invest the rest of the balance in a way that I think is going to achieve the highest return for the lowest risk. And hopefully, and most importantly, meet that 7% benchmark. So I wouldn't worry so much about dividend yield. Quite often people think, I've got to invest and all the income off the portfolio is going to pay for living expenses. No, it's going to be a combination of capital and income. But hopefully what we're still trying to do is generate some compounding capital growth, particularly as you're, relatively young at the beginning of your, well, relatively young, 60, it's young. And at the beginning of your retirement phase, want to make sure that you're still investing aggressively enough so that you are going to capture those returns, so you do benefit from long-term compounding capital growth, and therefore you can achieve a perpetual portfolio. As you've suggested, 2/3 of your money is in cash, essentially, and 1/3 is invested in the market. At the moment, you're way too conservative and you do risk running out of money. So, Shelley, that's some thoughts. It sounds like you need to find a really good advisor, one that doesn't charge $36,000 a year. Look, I think, advisors are going to charge somewhere between an annual fee, is probably somewhere between $5,000 to $10,000. That would be a reasonable fee in your situation. If you're managing sort of about $3 million of monies, it might be slightly more than 10 in terms of the upper end of the scale, but, something in that vicinity. But just to give you a better sense of, what fees you should be paying, 36,000 is, 3.5 times too much. Okay, next question is from Steve. Steve writes, I currently have $580,000 in industry fund, mostly taxable funds, some non-taxable. So for people listening, your balance is typically split between taxable and non-taxable. Non-taxable element typically comes from if you've made non-concessional contributions, because that money's already being taxed. And so when you take it out, if a non-financial dependent beneficiary receives your super one day because you've passed away, they're not going to be taxed on that. Anyway, there's taxable and non-taxable. Steve continues, right, I am 57 years old. I'm planning to put in $30,000 of concessional contributions and $120,000 of non-concessional contributions over the next 4 years. I'm wondering if I'm better off starting a second superannuation account to receive the non-concessional contributions. And so what Steve's asking here is, can I put all the non-concessional contributions into one account and all the concessional contributions, which are kind of tax-deductible contributions, into the other account? And then what Steve could do is start the pension on the fund that has the taxable component first. And if he then sort of spends all that money and takes all that money out of super, he could then start a pension on the other fund that has the non-taxable component, which is because it's being funded from non-concessional contributions, on the basis that if he is going to leave super to non-financial dependents, which would be independent adult children, for instance, that's not going to attract any tax. It's a really good idea, Steve, and you can do it. In terms of the lifetime transfer balance cap, that works across your whole super, but it doesn't mean you can only have one account, and it doesn't mean you can only have one pension account. What it means is that you trigger your lifetime cap when you first convert a fund, one account, into pension phase. And that transfer and balance cap is $1.9 million today. After 1 July, it's going to $2 million. So that'll be your lifetime cap that you've got to deal with. So if you had an account that had $580,000 in it and you convert it into pension, you would have $1.32 million left on your cap, your lifetime cap, because you've triggered the cap today, which is 1.9. You could then accumulate another $1 million in a accumulation account, so something that's not in pension phase, and then eventually convert that into pension, and that'll lead into another $1 million of your lifetime cap. So you then have $300,000 left. So that's how that works. It's fine. You can have as many pension accounts, as many accumulation accounts as you want. You can have both even in retirement. So for example, if you're in retirement, your main fund or your main account might be in pension, but you want to put some more money into super if you're allowed to do it, if you're within your non-concessional caps, that's fine. You can open a accumulation account and make those contributions. So it's a great idea, Steve. Good planning idea. If you're making non-concessional contributions, maybe split them into two different accounts, because obviously your beneficiaries will thank you for it because they'll pay less tax on the estate. If you don't do that, your one fund is going to have a mixture of taxable and non-taxable component, and when they pay a pension, they will pro-rata the pension over both those components. So you can never really choose, just pay the pension out of the taxable component. You can't do that. It's got to be pro-rated. The final thing you want to think about is just account fees, I guess. But, in an industry fund, they're going to charge you, $100 a year for an account. It's not going to be that cost prohibitive. Okay, next question is from Shan. Shan writes, I've been listening to your podcast every week since mid-24 and read both your books. Love your evidence-based approach and find your podcast very inspiring. Please keep up the good work. Thanks so much, Shan. My wife and I previously reached out to your firm to seek financial advice. Unfortunately, there's not enough scope to work on back then, so I apologise for that. But if we don't think it's worthwhile you paying for advice at this point in life, of course, we must decline that because ultimately that's in your best interest. My partner and I are both working professionals in our mid-30s, have a 2-year-old, and we're on the way to another newborn in the family within this year. Well, congratulations. I earn around 100,000 with 70 grand in a uni super account. So super account. My wife earns about 120 with similar balance in Australian super. Our portfolios are invested in high growth options inside super. Asset-wise, from the help with our parents, we already own our primary place of residence in Melbourne without a mortgage. Our home is worth $1.3 million. We also have 2 investment properties. Our first one is a house and land package in Perth, which we bought towards the end of 22 with a $470,000 mortgage, now worth $825,000. The other is an existing townhouse in an affluent suburb in southeastern Melbourne, which we acquired in late 2024 with a $1.3 million mortgage worth about $1.65 million. We think we are already very close to our borrowing capacity, if not hit it already. To help reduce the loan repayment pressure, our parents have also helped us with building a large safety net over the last few years. And as a result, we currently have $550,000 in the bank account. We're contemplating upgrading our home in the next 3 to 5 years to accommodate the growing family, but also want to effectively utilize the $550,000 cash in the meantime. We're not sure if we should put these funds in an offset account to reduce loan repayments or invest it in more liquid assets such as shares. We are aware that putting funds into the offset account gives us more cash flow, but the cost of reducing the benefit of negative gearing and would end up paying more tax. In the meantime, we're also concerned that if we put the money into the share market, we might not be able to sell them when we need them to pay for upgrading our home. Given our relatively young age, we don't think locking these monies away inside super is a good option, even though it's more tax-effective environment. We also know some of our friends have similar situations where they have a steady surplus cash flow from employment, cash gifts from parents, and own their own home with no mortgage. What would be your advice to someone in our situation? I appreciate you can't give individual advice on the podcast, and that's true. But if we could speak in a general approach and decision principles around the situation, we'd greatly appreciate it. Okay, Shan, great question. I mean, it all comes down to time horizon, the answer to your question. You've got $550,000 in an offset account. You want to upgrade your home within 3 to 5 years. So to my mind, you don't have the time horizon to invest those monies in a medium to long term approach, because the risk is that markets can recover relatively quickly from a volatility incident. And we saw that happen in 2020. They recovered by the end of 2020, the markets were almost fully recovered, and in some situations more than fully recovered. So it's a relatively short period of time. But you look to the GFC, it took about 2 years. So the risk is that you go and invest that 550,000, you get some GFC volatility event, and sure, okay, it'll recover hopefully within a 2-year period, but what have the returns been over that 3-year period? It's not going to be attractive. Versus putting it in the offset account, you are going to get a pre-tax return of, let's say, 6.5%, if that's what your investment loan is charging. And that return, that pre-tax return, that is risk-free, right? You're always going to get 6.5% no matter what happens. Of course, the RBA could change interest rates, but the return will equal the interest rate pre-tax. If you go and invest those monies, you've got to earn a lot more than 6.5% pre-tax to make sure that you're going to be much better off by doing that, to compensate you for the risk, because you've got a risk-free return and now you've got a return with risk. So you probably want maybe 6, 7, 8% return. So actually, whilst yes, it does reduce your interest costs and therefore reduce your negative gearing, although both you and your spouse are earning less than $130,000, so your negative gearing isn't going to be that material just because of the marginal tax rate that you're on. So yes, it will reduce it, but that's not the point, because the point is, if you didn't put it in there, you would earn investment income and you'd be taxed on that as well. So there's a tax consequence of taking the other approach. So because your time horizon is 3 to 5 years, I would leave the money in the offset account. And I get that you're in your 30s and you might think that's like not really doing enough. It's a lazy money. You're not taking enough risk. But you just don't have the time horizon. You really need to be able to rely on that money to make sure that you can upgrade your home. Now, if you took the home upgrade off the table, because you're talking about, some of your friends in a relatively similar situation, if you said to me, we're going to be in this home forever, we don't want to upgrade the home in 3 to 5 years, I would probably say to you something along the lines of, why don't we keep 150 grand of cash as a buffer in the offset account? Let's put that the remaining $300,000 to work. And I'd probably say, let's invest $10,000 a month for the next 30 months, drip feed that money into the share market, build a portfolio, and then expose some of that capital to, greater compounding returns. But I can do that because I've got a 10 plus year time horizon, and I know I can ride out market volatility, any market volatility that comes our way, and enjoy, average or above average returns over that period of time. So, Sean, that's how I would approach the answer to that question, and it really is a time horizon question. Okay, I'm going to squeeze one more question. The last question is from Jasmine. Jasmine, I thank you for all the time that you put into the podcast. Not only is it an amazing education tool, but it also helps listeners ask important questions on their own tax/financial questions and find the best help. So thanks so much for your feedback, Jasmine. Look, I really enjoy the Q&A episodes, and I'm really glad that listeners are too. And I do enjoy sort of answering the questions and taking you through the approach and getting to share, the craft that I've spent the last 20 years really honing and thinking deeply about. So it's a great opportunity for me too. Okay, so Jasmine goes on to write, my question relates to the structure for share investing. My husband and I are both in the highest marginal tax rate. He works as a sole trader but receives income via PAYG salary. My salary is all PAYG. As part of his work, he receives a fully franked dividend from the business he works in. This is paid into a standalone company that we are both 50-50 directors of. We have no other investments beside a $2.2 million home loan. We have approximately $300,000 in our offset account. We're both in our early 30s and expect our income to continue to rise with time. Given that we're highly leveraged with our mortgage, we have thought about share investing to begin with. I was wondering if you could speak to the advantages of investing in a company versus individual names. I understand that negative gearing benefits are better when investing in individual, but given that we have a healthy amount coming into the company, $5,000 to $10,000 a month, is there a way we could put it to better use? We are long-term investors and are looking at a 20 to 30-year time horizon. Great question, Jasmine. I mean, the first thing that I would think about, you said that you were both 50-50 directors of that company that receives the dividends from the trading company. So my understanding, as you've explained it, is you have a trading company. The shareholder of that trading company is another company, so just a standalone company, which you've described it as. My first question is, who owns the shares in that standalone company? Because the company is a really good entity to invest in the share market in, just because you always get a credit for any tax paid. And I'll get back to that in a second. But if we do want to pay a dividend out of that company, I want to have the flexibility. So what I would like I would like the shareholder to that company, the standalone company, to be a family trust. And that way, if I want to take money out of that company, it comes into the trust and then I can distribute it to whomever I like, whether that's children, adult children, parents, whatever it might be, in order to save tax. What I would encourage you to do, I only started using episode numbers about a year ago in the podcast, but I would refer you to an episode I recorded published on the 23rd of August 2023, a couple of years ago now. It's called "Would a Third Super Fund Help You Retire Early?" ? So I would just Google Pro Solution Third Super Fund. That'll take you to the blog, and then you'll find the podcast on that page. And that's where I talked about the advantages of investing in a company name, the many advantages of investing in a company name. But in your situation, what you want to do is just make sure that the shareholding is structured correctly before you start that. Because if that standalone company, if that shareholding isn't adequate, the question is, could you change it? And there might be some tax considerations around doing that. Or should you start a different investment vehicle that is structured correctly? That's what I'd certainly get right. But the thing is also, I was saying this to a client yesterday, in fact, that the regular share investing, if you're investing $5,000 to $10,000 a month, before you know it, and it might not seem like this if you're in your 20s or 30s, but 10 years goes past very quickly, right? And if you start doing this on a regular basis, you kind of get used to it. You don't really feel it from a cash flow perspective, but how quickly that money accumulates into a really substantial nest egg is really surprising. And it's a very effectual strategy. Just make sure that you're getting some advice. If you're going to invest $120,000 a year and you plan to do that for the next period of time, that's a lot of money. And you want to make sure that the portfolio is managed and invested well. So I think it probably makes sense, if you're in that situation, to get some formal advice around it, ongoing advice in terms of making those investments, and then just make sure the structure is correct. I kind of like it in terms of your strategy, because you are on the highest marginal tax rate. So this will be more effective because you'll be able to cap your tax at 25 to 30%, depending on your structure. And Although, a lot of listeners might think, oh, they got $2.2 million of non-tax deductible debt, which is relatively high, and I acknowledge that. Of course, they got 300,000 in the offset account, so about 1.9 net. So I get that you've got a high debt, but one of the best ways to kind of mitigate, or one of the additional ways other than cash flow to mitigate, debt repayment is just build that asset base. And I'm sure you've probably got a lot of equity in your home, and that'll build over time as well. But if you can build this other nest egg in a company, in a standalone company that's nice and protected and tax effective, that's a really great way to sort of mitigate the risk that your future cash flow isn't enough to be able to repay that debt. So thanks heaps for your question, Jasmine. As I said, just have a look at that podcast, the 28th of August, 2023. I think you'll find a lot of the answers into that question. And for other listeners that hasn't seen that episode, it's well worth going back and having a listen to it. I think a lot of people would benefit from it. And on my list to write about, particularly for self-employed people, is investing in property, borrowing to invest in property in a company name. And the pros and cons of doing that, I'm starting to like that more and more as time goes on. So that's on the cards over coming weeks. I haven't written that blog yet, but I'll get to it, I promise. Okay, I think we're finished for today. Thanks very much. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.